Okay, so let's start. We want to continue from where we left. Last time, we were discussing the topic of retirement benefits, you remember? And we had started, or we were doing the discussion of other terms that are used in pension, And we had talked about one of them being the current service cost, what is the past service cost, what is an actuarial gain, what is an actuarial loss, what is an experience adjustment, what's an experience surplus, what's an experience adjustment, and so on. We had discussed all of them. What was remaining was to give out the notes, okay? So, maybe before we put down the first one, the notes for the first one, let me remind you what we said is a current service cost. We said this, that assuming as a company you have been operating your business for many years, and all those years you did not have a pension scheme. Come this year, and we were assuming our current year is 2020, come this year, you decided as a company you're going to initiate a pension scheme. Then we said, it means therefore, every month the employees will give you a service. You will send contributions for that service to the pension fund. Again, another month the employees will give you a service. You send contributions for that service to the pension fund. That kind of a contributions for services rendered after the scheme was initiated, after the scheme has been initiated, we said that kind of a contribution is what we were calling the current or the present service cost. Let me connect it with the second one so that we put down the two first, when we put down the notes for the two. Then we said, what if again, yes, you started your pension scheme in the year 2020. But that is not the year you started your business. You started your business many years ago. But all those years, you did not have a pension scheme. But you as an employer, you want to contribute this year 2020, you want to contribute for the services the employees gave you for 2019. Remember 2019, you did not have a pension scheme. You want to contribute this year 2020 for the services the employees gave you in the year 2018. So how do you account for that service cost? We said you account for it as a past or a prior service cost. So we said these are contributions made for services rendered before the scheme was initiated. So you will account for them as contributions made for services rendered before the scheme was initiated. So I think we can put down those two. Terms for the first two. So have a subheading, other terms used in pension. Number one, current service cost. Current, unaweza andika current stroke present service cost. Then you say this. These are contributions made, current stroke present service cost. You can say this. These are contributions made for services rendered. After the pension scheme has been initiated. These are contributions made for services rendered, or these are contributions made to a pension scheme. These are contributions made for services rendered after the initiation of a pension scheme. Put it that way. These are contributions made for services rendered after the initiation of a pension scheme. After the initiation of a pension scheme. That's all for number one. We can now go to number two. Number two, andika present or past, sorry. Number two, past stroke prior service cost. Past stroke prior service cost. Past stroke prior service cost. Then you say this. These are contributions made. These are contributions made for services rendered. These are contributions made for services rendered before the scheme was initiated. These are contributions made for services rendered before the pension scheme was initiated. These are contributions made for services rendered before the pension scheme was initiated. Before the pension scheme was initiated. Good. That's all for number two. We want to go to number three now. But before I talk about number three, or before we put down number three, let me remind you what we said. We said, how many ways can you as an employer go into a pension scheme? Last time, we discussed two types of a pension scheme. You remember? One was what we were calling the defined contribution plan. And the second one is what we were calling the defined benefit plan. The defined benefit plan. For the defined contribution plan, listen, for the defined contribution plan, we said contributions are made into the scheme. Okay, first we discussed how a pension scheme operates, where we said contributions are made, regular contributions are made to a pension fund. Those contributions are normally invested, and it is the funding agent who pays the benefits to the employees when they retire. That's what we said on how a pension scheme operates. Okay. Then after discussing that, we saw in what ways can you as an employer go into that kind of arrangement. We said there are two ways. One is to use the defined contribution plan approach, or to use the defined benefit plan. In a defined contributions, don't forget we said the contributions are defined. In a defined contribution, how much you as an employer you'll be sending to the pension fund, those contributions we said are defined. They are known in advance. But how much the employees will take home at the date of retirement, we said those benefits are not defined. How much the benefits will be, we said last time, will depend on the performance of the investments in the fund. We said if the investments perform well, then the benefits will be more. If the investments perform poorly, then the benefits will be less. That was all concerning defined contribution. The second approach which we want to borrow now is the defined benefit plan. And you remember we said in a defined benefit plan, how much the employees will take home. At the date of retirement, those benefits are defined. In a defined benefit plan, the benefits that the employees will take home, we said, they are defined. They are known in advance. Like you can see, we were assuming that the employee will take home 1 million 10 years from now. But the contributions that are made to this fund, in a defined benefit, we said the contributions are not defined. We said the contributions are set at such an amount that is expected, to earn enough return, to meet that obligation of paying the benefits. So we said, if we want to create a fund of 1 million 10 years from now, how much should I as an employer contribute to this fund? In that case, we said, you will require the services of the actuaries. You will come up with the assumptions of the scheme that you want to develop. What assumptions do you come up with? One of the major assumptions, we said, you will project what is the rate of return in the market. The other assumptions is, how many employees do we have? What is their current salary? When are they going to retire? What is the turnover rate? Come up with the assumptions of the scheme. Then we said, suppose we projected that the market will be earning a return of 10%. The actuaries will sit down and calculate and find out, how much should I contribute into this fund in order that 10 years from now, it will create a fund of 1 million earning a return of 10%. We were assuming, suppose they calculate and see that I'm supposed to be contributing 2,000 every year or 2,000 every month, whatever it is, expecting it to earn a return of 10%. Then we said, what if it happens that after 2 years, now your fund is no longer earning a return of 10%, but your fund is earning 12%. Your fund is earning 12%. What will happen? We said, if as an employer I continue contributing 2,000 into this fund, expecting it to earn 10 but now earning 12%, then we said that fund will be larger than expected. That fund will be larger than expected. And so we said that will give rise to what we were calling an actuarial gain. What if, then we said, what if we projected to be earning 10%, now we are contributing 2,000, but it happens maybe after 2 or 3 years, your fund now starts earning not 10%, but starts earning 8% now. What will happen to the fund? Will you be able to meet your obligation of paying that 1 million? We said no. Your fund will have a deficit. Your fund will have a deficit. Okay? And so we said that will make your fund to have an actuarial loss. That will make your fund to have an actuarial loss. And so we defined what is an actuarial loss and what's an actuarial gain. And we said, when the actual earnings in the fund, exceed the projected earnings. Our actual earnings could be 12% while we projected 10%. When the actual earnings in the fund exceed the projected earnings, then we say that makes the fund to have an actuarial gain. But when the actual earnings in the fund are less than the projected earnings, then that makes the fund to have an actuarial loss. So an actuarial loss, we said, occurs when the actual earnings in the fund are less than the projected earnings, Good. Now, before we put down that, there is this other term we talked about, number 4, what we were calling experience surplus or deficit. We discussed it, and it's almost related to what I've just said. We want to create a fund of 1 million 10 years from now. That's our obligation. And so we said, if you want to know whether your fund as a company, is our fund able to meet that obligation of paying 1 million 10 years from now, for you to know whether your fund is able to pay that 1 million or not, we said you can, as an employer, you can compare the assets of the fund with the liabilities of the fund. Of course, the liabilities are those future obligations that you'll be required to pay the 1 million 10 years from now. Our assets of the fund that we said are in form of investments. Don't forget, we said every time you as an employer you send contributions to a fund, we said those contributions are normally invested. So the investments in this fund form the assets of the fund. So we want to know, as a fund, shall we be able to meet our obligation of paying the benefit in the future? So you compare the assets of the fund with the liabilities of the fund. And we said, if you realize that the assets of the fund exceed the liabilities of the fund, then that gives rise to what we were calling an experience surplus. And if you realize that the assets in the fund are less than the liabilities in the fund, then that gives rise to what we were calling an experience deficit. So we said an experience surplus occurs when the when the assets of the fund are more than the liabilities of the fund. And of course, when does a fund have a surplus? It is when it's earning more than required. We projected to earn 10%, now we are earning 12%. It will create a surplus. Okay? Deficit occurs when we thought we shall earn at 10%, but now we are earning at 8%. That will create a deficit. So an actual gain or an experience surplus, both of them we said occur under the same circumstance, but when you're told to define what they are, we said if you are told to define what's an actual gain or loss, don't use the assets perspective. No. Instead, look at the fund from the point of view of its earnings. If the actual earnings exceed the projected earnings in the fund, that will give rise to an actual gain. And if the actual earnings in the fund are less than the projected earnings, then we said that gives rise to an actual loss. Then when is a surplus? A surplus occurs when the assets in the fund exceed the liabilities of the fund. Experience deficit occurs when the assets of the fund are less than the liabilities of the fund. Good. So let's put down those next two. I have terms. One, actual gain, stroke loss. So andika number next. Number 3, actual gains, stroke losses. 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 Then you say this. Then you say this. Actuaries deal with several uncertainties. Actuaries deal with several uncertainties. Actuaries deal with several uncertainties. When estimating, actuaries deal with several uncertainties when estimating the cost of a pension scheme. Actuaries deal with several uncertainties when estimating the cost of a pension scheme. Actuaries deal with several uncertainties when estimating the cost of a pension scheme. Will you stop? Continue. In resolving these uncertainties, they usually make some assumptions. They usually make assumptions. In resolving these uncertainties, they usually make some assumptions. Then you see this. Assumptions are made on areas such as assumptions are made on areas such as assumptions are made on areas such as market interest rate, retirement date, workers turnover rate, etc. And you say this, rarely do the projected results coincide with the actual results. Rarely do the projected results coincide with the actual results. Comma. Therefore, giving rise to actuarial gains stroke losses. Therefore, giving rise to actuarial gains stroke losses. Therefore, giving rise to actuarial gains stroke losses. Another paragraph. Actuarial gains occur where the actual earnings in the fund exceed the projected earnings. Actuarial gains occur where the actual earnings in the fund exceed the projected earnings. Where the actual earnings in the fund exceed the projected earnings. Another paragraph. Actuarial losses occur where the actual earnings in the fund are less than the projected earnings. Actuarial losses occur where the actual earnings in the fund where the actual earnings in the fund are less than the projected earnings. Actuarial losses occur where the actual earnings in the fund are less than the projected earnings. Good. That's all for actuarial gains or losses. Now we go to the next term, another subheading, number 4, experience surplus stroke deficit. Let's go to number 4 now, experience surplus stroke deficit. Experience surplus stroke deficit. Experience surplus stroke deficit. Then you see this. In determining whether a fund is able, in determining whether a fund is able to meet its obligation, in determining whether a fund is able to meet its obligation of paying the benefits, in determining whether a fund is able to meet its obligation of paying the benefits, in determining whether a fund is able to meet its obligation of paying the benefits, comma, the fund assets are compared. The fund assets are compared with the fund liabilities. The fund assets are compared with the fund liabilities. In determining whether a fund is able to meet its obligation of paying the benefits, comma, the fund assets are compared with the fund liabilities. Another paragraph. An experience surplus occurs. An experience surplus occurs. An experience surplus occurs where the fund assets, an experience surplus occurs where the fund assets exceed the fund liabilities. An experience surplus occurs where the fund assets exceed the fund liabilities. An experience surplus occurs where the fund assets exceed the fund liabilities. Another paragraph. An experience deficit occurs. An experience deficit occurs. An experience deficit occurs. An experience deficit occurs where the fund assets are less than. An experience deficit occurs where the fund assets are less than the fund liabilities. Where the fund assets are less than the fund liabilities. Good. We go to the last term. We now go to the last term. So let me remind you what it is. And the last one is what we were calling experience adjustments. Of course, we discussed about it. And so we just want to remind ourselves. Listen, we said this. If your fund has an experience surplus, meaning it's larger than expected, meaning it has an actuarial gain, where we said, if I continue contributing 2,000, expecting to earn 10%, but it's now earning 12%, what will happen to this fund? We said that fund will be larger than expected to pay for the benefit of 1 million. So what will the employer be required to do? We said the employer may be required to take what we were calling a contribution holiday. I hope you remember, we were saying the employer will be required to take what we were calling a contribution holiday, where we said the employer will be required to do what? To stop contributing for a short while. So when your fund appears to be larger than expected, then if we continue contributing 2,000, earning 12%, that fund will be more than required. We don't want the fund to be more than required. So what will the employer be required to do? To stop contributing for a short while until we utilize that excess. Once we utilize that excess, then he can now continue later to contribute. That's one. Alternatively, we said, what if we projected to earn 10%? Now we are earning 8%. Instead of 10, what will happen to the fund? That fund will have a deficit. So, if it has a deficit, what do? Remember, we said we can't change the benefit. The employee must take home 1 million 10 years from now. So the only thing we can play with is contribution. So if the fund has a deficit, then we said the employer will be required, because if we continue contributing 2,000, we shall not be able to meet our obligation. So we said in that case, the employer will be required to make additional contribution. We said the employer will be required to bring in additional contributions into the fund so as to make up for the expected shortfall. Whatever is the expected shortfall, he will be required to meet it. So he will bring in additional contributions so as to make up for the expected shortfall. Those two are what we were calling the experience adjustments. So we said experience adjustments are those adjustments that are made in a fund, either to correct an experience surplus or to correct an experience deficit. To correct an experience surplus, we said, let the employer take a contribution holiday. To correct an experience deficit, let the employer bring in additional contributions. So let's put down that number 5. Let's put down that number 5. That is experience adjustments. Experience adjustments. Experience adjustments. Then you say this. These are adjustments. These are adjustments made. These are adjustments made in a fund. These are adjustments made in a fund to correct. These are adjustments made to a fund to correct either an experience surplus or an experience deficit. These are adjustments made to a fund to correct either an experience surplus or deficit. Another paragraph. Another paragraph. Another paragraph. To correct an experience surplus. To correct an experience surplus. To correct an experience surplus, the employer will be allowed. The employer will be allowed to correct an experience surplus. The employer will be allowed to take a contribution holiday. The employer will be required to take a contribution holiday. The employer will be required to take a contribution holiday, i.e., stop contributing for a short while, i.e., stop contributing for a short while, stop contributing for a short while. Another paragraph. To correct an experience deficit, to correct an experience deficit, to correct an experience deficit, the employer will be required. The employer will be required. The employer will be required to make additional contributions to the fund. The employer will be required to make additional contributions into the fund. The employer will be required to make additional contributions into the fund so as to make up for the expected shortfall. The employer will be required to make additional contributions into the fund so as to make up for the expected shortfall. So as to make up for the expected shortfall. Good. So that's all we had discussed last time, in which we have reminded ourselves, and so we have also put down the summary notes. Good. So let me develop the topic now. Let me develop the topic now. Finish. I want to develop the topic now. Okay, now listen. We said there are two ways in which an employer can go into a pension scheme. One is through, or what we were calling types of pension plans. One is what we were calling defined contribution plan. On right. The second one is what we were calling defined benefit plan. Defined benefit plan. Good. Now, how do you account as an employer? How do you account for these two types of plans in your financial statements? In other words, how do these pension plans affect your financial statements? The financial statements, of course, includes income statement and balance sheet, which is the statement of financial position. How do they affect? That's what I want to talk about now. Listen. In a defined contribution plan, I hope you still remember we said that as an employer, you make a regular contribution. For example, we were assuming 2,000 every month. So now that you know your obligation, you as an employer, whatever is that contribution you are making every year, you will be recognizing it as an expense. So you will just be debiting the expense account, which you go to the P&L account, of course, and you will credit bank. Every year you pay the 2,000, whatever you agreed with the actuary, whatever you agreed with the funding agent that will be contributing, that will become the charge for the year. Just debit P&L account, which is you debit expense and you credit cash. If you have not paid, you still recognize expenses, don't forget, and you credit the accruals. Just like any other expense, that if it's not paid, it goes to the balance sheet as an accrual. Okay? That's all we can say. Listen, that's all we can say about how to account for a defined contribution plan in the books. Just whatever is paid, just debit P&L account or just debit expenses and credit bank. If you have not paid, take it to the balance sheet as an accrual. Good. That's not a big deal. The issues normally come up with when you're dealing with a defined benefit plan. That's what I want to talk about, and that's where your questions normally now come in. So we are now starting the computation part of your topic. Now we are starting the computation part of your topic. So allow me now to start the discussion about how a defined benefit plan affects your income statement. In other words, what will you charge to the income statement as the charge for the year for expenses? What will you take to the balance sheet? Or how does a defined benefit plan affect your balance sheet? That's what we want to talk about now. Okay? Let me introduce it now. Now, this pension fund that you as a company you are running, this pension fund, don't forget, we said this fund can be looked at from the point of view of its assets. You can also look at this fund from the point of view of its liabilities. You look at it from the point of view of its assets because every time you as an employer you send contributions to the fund, those contributions are normally invested. So your fund has assets in form of investments. So you can look at your fund from the point of view of its assets. You can look at the same fund also from the point of view of its liabilities. Why? Because by the time the employees are retiring, you as a company, you are required to pay them their benefits. Those are the obligations, those are the benefits, those are the liabilities you are going to incur as a fund. Is it an allowable expense for purpose of tax? What? Yes, it is. It's of course allowable. It's of course allowable. Pension expenses are allowable. Moses, you're asking whether the expenses for tax, whether the expenses are allowable for tax. I don't teach tax, but I believe it's a normal business expense and therefore it should be allowable for tax purposes. It should be allowable. Yes. I've never heard of a scenario where pension expenses are not allowable. They are allowable for tax purposes. Okay, good. Now let's continue. So we want to look at how a defined benefit plan affects your balance sheet and your income statement. But before we do that, I've said from the fund point of view, you can look at this fund either in terms of its assets or in terms of its liabilities. Yeah? So let's first start by looking at the fund from the point of view of its assets. Yeah? Now, I also want to assume that our current year is 2020. In this year 2020, what happened to the assets of the fund? Then we also look at the same year 2020 and ask ourselves, what happened to the liabilities of the fund? So, assuming the question tells you that by the beginning of this year 2020, your fund as an asset or your fund has investments or assets worth a billion shillings. Let us assume billion in terms of shillings millions. That is it. So we want to look at this fund from the point of view of its assets first. We have said the assets are in form of investments. Maybe the question tells you these assets are worth a billion shillings by the beginning of the year. Of course, during the year 2020, there could have been transactions, and normally there are transactions which normally affect the value of your assets. Some of the transactions that took place in the year 2020 will make the value of your assets to go up, and some of the transactions will make the value of your liabilities to go up, the value of your assets to go down. So you will be required to identify what are the transactions that took place in the year 2020 which affects the value of the assets. For now, let me not mention them, but let me just say some of those transactions will increase the value of the assets, some will reduce the value of the assets. Listen to this now. Once you incorporate those transactions, you as a company, you will get, listen, you as a company will get what you think ought to be the value of your assets by the end of the year. Assuming you think your assets ought to be 990 million as per that calculation. You add this, you minus this, you add this, you minus this. According to us, our assets ought to be 990. What you will do as a company, you will now call in the actuaries and you will tell them to value your fund. You will ask them to value your fund and give it a valuation in terms of assets. They might value your assets by the end of the year and see that by the end of the year, your fund assets are what? Maybe 1020. So while we thought our assets ought to be 990, the actuaries gave us a valuation of 1020. There is a difference of 30. That 30 is what we shall be calling the actuarial gain or loss. It will be either an actuarial gain or loss for that year. For example, while we thought our assets ought to be 990 as a company, the actuaries gave us a valuation of 1020. So we have more assets than we thought we would have. And therefore, as a company, we made a gain that year. Okay? Some of your questions give you data for 2 years, 3 years, and so on. If they give you data for 2 years, then it means whatever was the balance carried down last year, 2020, that will automatically become the opening balance for the year 2021. So our closing balance last year was 1020, bring it down. Then again, look for those transactions that took place in the year 2021, which again affect the value of the assets and also either increasing or reducing, whatever it is. We shall discuss them later. Again, once you identify those transactions, get what you think as a company ought to be the value of your assets by the end of 2021. Let me assume now you think your assets ought to be 970. Then you called in the actuaries again by end of the second year, and you told them, please value our fund and give it a valuation in terms of assets. They might tell you, no, your assets are not 970 this time, your assets are 960. There's a difference of 10. While we thought our assets ought to be 970, the actuaries gave us a valuation of 960. So we have less assets than we thought we should have, and therefore, as a company now, we have what we are calling an actuarial loss on assets in the second year. So now listen. So what we normally do, I am discussing how a defined benefit plan affects the financial statements. Which are these financial statements? The income statement and the balance sheet. But before we look at how they affect the income statement, in other words, how much do you take the income statement as an expense, just like I did for defined contribution? Before I determine that amount that goes to the balance sheet or to the P&L account as an expense, there are some steps that we normally follow. And one of the steps which I've already discussed is that you as a company, you are required to first calculate what we call the actuarial gain or losses. You compute what we call the actuarial gain or losses on assets of the fund and also on the liabilities of the fund. I've told you every fund can be looked at from the point of view of its assets and also from the point of view of its liabilities. Okay? So now I'm assuming we have done the calculation from the point of view of assets. Though we are not through yet, we have not identified the transactions, but I'm assuming you have identified them. Now, at the same time again, now look at the same fund, but now in terms of its liabilities. Again, ask yourself, in the year 2020, our fund as a liability, could it have made an actual gain or a loss again? Listen, again the question will tell you, by the beginning of this year 2020, how much was our fund having as a liability? What was the liability of the fund by the beginning of this year? Whatever it will be. Maybe the question again gives you 1,000 or 1 billion shillings. Okay? Whatever it is. This is for the year 2020. Then again, you will identify the transactions that took place in the year 2020 which affects the liabilities. Some of those transactions will make the liabilities to go up. Some of them will make the liabilities to go down. Again, once you identify those transactions, get what you think as a company ought to be the liabilities of the fund by the end of the year. Suppose you take the 1,000, you add this, you minus this, you add this, you minus this, and you get that according to you as a company, your liabilities ought to be 1010. But then you will call in the actuaries and tell them, can you value our fund and give it a valuation in terms of liabilities? So by the end of the year, the actuaries might give you a valuation of 1020. So while you thought your liabilities by the end of the year ought to be 1010, the actuary said, no, your liabilities are not 1010. Your valuation or your liability should be 1020. There's a difference of 10. Again, that 10 is what you will call The actual gain or loss, again, we are determining it as a balancing figure, is what you will consider. So from here, it is obvious. Even if I ask you, you should be able to tell me whether now you think this 10 is a gain or loss. So somebody can chat, tell me, do you think that 10 million is a gain or loss? Do you think that 10 million is a gain or loss? Let me hear now. At least now you should be able to conclude. While we thought our liabilities ought to be 10-10, the actuary said, no, your liabilities are not 10-10, your liabilities are 10-20. So is that a gain or a loss? As a company, listen carefully. I'm not saying Esther is wrong, but I'm saying, remember, you as a company, you are managing. I'm not saying, Esther, you are wrong. Why have you deleted? Listen, you are managing this pension fund on behalf of your employees. You as a company, you are managing this pension fund. I told you last time that this is not your money. You are managing it on behalf of your employees. So if according to you, you owe them 10-10, but the actuary says, no, you don't owe them 10-10. You owe them 10-20. So the question is, that 10 million, is it a gain to us as a company, or is it a loss to us as a company? As a company, is it a gain or loss? Now Esther says it's a loss. Sour, good. It's a loss. Why? Because now we owe, true? Now we owe our employees, now we owe them more than we ought to pay them. We owe them more. So that's a loss to us. That's a loss to the company. Okay? Again, if the question gives you data for 2 years, whatever was the closing balance last time, that becomes the opening balance in the next year, 2021, you have 10-20. Again, you will identify the transactions that took place in the year 2021, some of them increasing the value of the assets, some of them reducing the ability, and also some of them reducing the liabilities. Good. Again, listen, suppose you compute the data for 2021 and you realize that we as a company, our liabilities ought to be 10-50. But when we called in the actuaries, they said, no, your liabilities are not 10-50, but instead your liabilities are 10-30. So there is a difference of 20. So while we thought our liabilities ought to be 10-50, now our liabilities are less than we thought. And therefore, as a company, we now owe less amount to our employees. We owe them less. So to us as a company, that is obviously a gain. So normally, that is always the first step, to compute what we call the actual gain or loss on assets and on liabilities. Okay, good. Now, before I go to the next step, I want to take you back to this procedure again. I have just been saying, identify the transactions that affect the assets and identify the transactions that affect the liability. Some of them will increase assets, some of them will reduce the assets, and whatever. Now I want to go back and look at each of those transactions, which are these. Now, we go back and look at our fund from the point of view of its assets. We began the year with assets worth 1 billion shillings. I have told you those assets are in form of investments. Because every time you as an employee, as an employer, you send contributions to a fund, those contributions, I said, are invested. So they are in form of investments. So it is obvious, therefore, that this year, as a fund, we expect our investments to earn a return. We expect an investment income from our investments. So one of the transactions that will affect the value of your assets are what we shall be calling expected rate or expected return on assets. Expected return on assets. The question might tell you, we expect a return of 10% every year. So if our investments were worth £1 billion and we expect a return of 10%, 10% of 1 billion is 100 million. The question is, will that 100 million make the assets to go up or make the assets to go down? It is obvious, listen, it is obvious when we have assets amounting to 1 billion and those assets are earning a return of 10%, which is 100 million, that will make the assets, the value of the assets to go up. The investment income will make the value of the fund assets to go up. Good. So that's one of the transactions that affect the value of the assets. Another one. Every time you as an employer, you send contributions to the fund, those contributions that you are sending to the fund, how do they affect the assets of the fund? Every year you will be sending contributions to the fund. So whatever contributions that the fund receives also affect the assets. Whatever contributions are received. Contributions received. Obvious. Let us assume you as a company, you had to send 30 million shillings this year to the fund. Obvious, that will make the value of the investments to go up. You are funding that investment or that fund. You are giving it more funds. So the assets of the fund will automatically go up. That's another transaction that affects the value of your assets. Okay? Where we are saying any contributions that you as an employer you have paid to the fund, which is the same as saying any contributions that the fund has received from you as an employer. Okay? Good. So that's another transaction. Next one. If by end of this year or during the year some employees retired, assuming some employees retired during the year, and as a fund we paid them their benefits, some of the employees retired this year, and we paid them benefits this year, then it's obvious whatever benefits that your company paid to the employees this year, whatever benefits that they paid to the employees this year automatically will affect the value of the assets. Why? Because you are paying them by cash. So money in the bank will go down. Money of the fund will go down. So any benefits paid by the funding agent or by the fund will make the value of the assets to go down. That is it. So I have identified for you the transactions that normally affect the value of the assets. One is the expected return on assets. That's what I've said makes the value of the assets to go up. I also said any contributions received by the fund. In other words, what did you send this year to the fund? Or what did the fund receive this year as contributions? That will automatically make the assets of the fund to go up. If there are some employees who retired this year, they were paid some benefits. So whatever benefits were paid this year automatically reduces the assets in terms of cash. Good. So assuming that's all, then you add, you minus, and you get 990. That's the time now you will call in the actuaries and tell them, can you value our fund? They will tell us, no, our assets are not 10,990, your assets are 10,20. So we thought our assets are 990. Now we are being told they are 1020. As a company, we have a gain. You will repeat the same process for year 2 and so on. Now we go and discuss the liabilities. What are the transactions that affect liabilities in a fund? I told you we owe. Liabilities are obligations. We owe the employees as a fund. We owe the employees 1 billion shillings by the beginning of the year. Meaning, I told you, we as a company, we are managing a pension scheme on behalf of the employees. I told you, this is not our money. No. This is money that we owe to the employees. So by the beginning of this year, we owe them 1 billion. Meaning, it's like the employees have given us a loan. It's like they have given us a loan. When they give us a loan, of course, they will charge you interest. From the point of view of the employees, it will be like an income to them. But from your point of view as an employer, that will be a cost. Whatever they are charging you as interest this year will be a cost to you. So one of the transactions that affect the liabilities is what we call the interest expense. The question will tell you what is the discount rate in 2020. Maybe the discount rate was 5% or 10% and so on. So now that we owe the employees 1 billion by the beginning, and it's like they are charging us interest of 10%, that's a discount rate, then for the interest that I'm owing to them, remember it's their money, which they have given me to manage, 1 billion, they are charging me interest of 10%, which comes to how much? 100 million. Which automatically means that 100 million again increases what I owe to my employees. So one of the transactions that affect liabilities is the interest expense. That interest expense makes the liabilities of the fund to go up. Another one. During the current year, the employees must have given you a service. And we said, every time the employees give you a service, you send contributions for that service. So whatever is the service cost this year, whether it is the current service cost or past service cost, it doesn't matter. Whether it's the current service cost or past service cost, it doesn't matter, current or past service cost. That amount is an amount that you as a company, again, you owe to the employees. They have given you a service this year worth 50 million. Listen, whether you have paid it or not, you owe that amount to them. They have given you a service worth 50 million. So that 50 million is what you owe to them. I have not said that you have sent contributions worth 50 million. No. To the fund, you could have sent this, like I can see here, you sent contributions worth 30 million to the fund. That's what you sent. But this year you are supposed to send how much? 50. That's the service they have given you. So what I recognize as my liability increasing is not what I have paid for their service this year. You could have paid less. But what is it that they have given you in terms of amount? They have given me a service worth 50 million. So I recognize that as an amount that I owe to them, not what I have paid. That increases our liabilities to them. Good. So number one is the interest expense, makes my liability to them to go up. The service cost that they have given me of course makes my liabilities to also to go up. Listen, during the year, some employees retired. And as a company, we paid them some benefits. Does it affect our liabilities? Yes. Whatever benefits we paid this year automatically must have reduced the assets up there. Whatever you paid as benefits, I told you reduces cash. But at the same time, it also reduces what you owe to them. So whatever benefits you paid this year automatically will reduce the value of your liabilities. So benefits paid, listen, are used in both calculations of the assets and the liabilities. They are used in both calculations of the assets and the liabilities. Whatever you paid this year reduces the liabilities, so you debit liabilities. It reduces the asset of cash, so you credit cash. When you paid benefits, you normally debit bank, you normally debit liability, credit bank. That's what you do. Good. So again, having identified the transactions affecting liabilities, one of them being the interest expense, the service cost, the benefits paid, then again you computed, and you saw we think our liabilities ought to be 1010. We called in the actuaries, they told us no, your liabilities are 1040. Let's change now, 1040. While we thought our liabilities are supposed to be 1040, but now they are 1010, we have a difference of 30. While we thought our liabilities ought to be 1010, now they are more than we think they ought to be. So we have an additional loss of 30. Good. So you have an actual loss of 30 for liabilities. Then you repeat the same for the second year and so on. Some questions give you data for 3 years, 2 years, whatever it is. Good. So I've done the first step and the major step. Now, we want to look at now, how does this fund affect the income statement? Listen, from the transactions we have identified that took place in the year 2020, either affecting assets or affecting liabilities, listen, some of those transactions automatically should go to the P&L account. So how do we determine what goes to the P&L account as the pension expense? As a pension expense. What goes to the P&L account as a pension expense? Listen to this. There are several transactions that took place in the year 2020 which normally, listen, which normally should go to the P&L account. Listen. But the requirement of the accounting standard is, that you don't take to the P&L account those individual transactions. No. You are required to get a net of all of them as a single amount. Then you get the net of all of them. That net of all of them is now what you call net pension expense, which you now take to the P&L account. Let me ask you, if you look at the transactions that affected liabilities here, we have identified 3 transactions that normally affect liabilities. One of them is interest expense, service cost, and benefits paid. Do you think that there is either one or two or all that normally should go to the P&L account? Do you think out of those 3, there is any one of them that should normally go to the P&L account? Yes, obvious. One of them is the interest expense. That should go to the P&L account as an expense. Okay? That's one of them, or the transaction that normally goes to the P&L account. That's interest expense. From the point of view of the liability, we have another cost called service cost. Again, listen. For the service cost, I told you Whatever service the employees gave you, you should recognize it again as an expense. It's not what you paid for their service. Listen, it's not what you paid for their service. No, it is what was the charge for the year, the service. Like I told you, here the employees gave you a service worth 50 million. But when you are sending contributions for that service, you send contributions of only 30 million. But you all know, whenever you are preparing an income statement, we normally follow a concept called accrual concept. And the accrual concept states what? That we recognize costs when they are incurred, but not when money is paid. You recognize costs when you recognize costs when it is incurred, but not when money is paid. So this year, we incurred a cost of 50 million for the service the employees have given us. Whether we have paid for it or not, the income statement should recognize it. Why? Because it's an accounting rule that you recognize costs when they are incurred, but not when money is paid. So this year, the employees gave us a service of 50 million. You recognize that cost as an expense. So the second one is what we are calling the service cost. Whether it is a current service cost or a past service cost, it's a cost that you have incurred. Good. Does the third one affect the P&L? According to the liabilities, we have seen there are three transactions. There was this interest expense, service cost, and benefits paid. Does benefits paid go to the income statement? Does benefits paid go to the income statement? The answer is no. Why? Because I told you, when the employees were retiring, you paid them whatever you paid as their benefits. I told you the double entry is you just debit liability, credit bank. Debit liability, credit bank. So that does not go to the P&L account. No, it's not a P&L account transaction. So benefits paid don't affect the income statement. No. So it means therefore, listen, it means therefore, from the point of view of the liabilities, there are only two transactions that should normally go to the P&L account. One of them is interest, two, service cost. Good. So we are through from the point of view of liabilities. Look at the same fund from the point of view of assets. What are the transactions that took place during the year and which should normally go to the P&L account? Should go to the P&L account. I've told you, the requirement is you don't take to the P&L account individual transactions. No. I told you, get the net of all of them as a single amount. Now, we began the year with the investments worth 1 billion shillings in terms of assets. We expect a return of 10%, which is 100 million. It is obvious, I told you, that is an income that your assets are earning. So it should obviously go to the P&L account as an income, not as an expense, as an income. Whatever is the expected rate of return or expected return on assets, that normally goes to the P&L account as an income. Listen, an income is always a credit balance, but I've told you should not take to the P&L account individual items. No, you get the net. So another transaction that should go to the P&L account is what we call expected return. But don't forget, the first two, which is the interest and the service cost, are a debit in the P&L account. The expected return is an income, meaning it's a credit. So to get the net of all of them, this expected return on assets should be deducted so that you get the net. Okay, good. Go back to the asset. Is there another transaction? Listen, we have identified the expected return on assets. Another transaction that took place in the affecting assets is contributions received. Does it affect P&L account? The answer is no. I just told you, every time you send contributions to the fund, what happens to the assets of the fund? The assets of the fund are increasing. But that's not the service the employees gave it to you. It is the service that goes to the P&L account, the charge for the year that goes to the P&L account, not what you paid. So this 30 being what you paid does not affect P&L account. No. Next, benefits paid. Does it affect P&L account? I told you no. Why? Because when you paid benefits, the double entry is you just debited liability, credited bank. Debited liabilities, credited bank. So does it affect the liabilities? Does it affect P&L account? No. Good. So from the point of view of assets, there is only one transaction that should go to the P&L account. That should go to the P&L account, and that is the expected return on assets. Good. Once you identify those transactions, get the net as a single amount. Two of them are expenses. One of them is an income. You net everything, get what we are calling net pension expense. Then you repeat the same for year 2, year 3, year 4, if the question is for 4 years, whatever it is. Good. So now you know how a pension fund affects the income statement. In other words, how do we calculate the net pension expense? Good. What about balance sheet? How does a defined benefit plan affect the balance sheet? Listen to this. Obvious, you know, in the balance sheet there are assets and liabilities. Good. If you look at your fund as a liability, come the end of this year, we called in the actuaries, and they gave us a valuation in terms of liabilities down here. How much? 1040. So in true sense, that should go to the balance sheet as a liability. We have a pension liability of 1040. When you look at the fund as an asset up here, we saw by end of the year, our fund as an asset was worth how much? 1020. Our fund as an asset was worth 1020. Okay? But again, that should normally go to the balance sheet as an asset. That should normally go to the balance sheet as an asset. Listen to this now. But again, just like expenses, you don't take to the balance sheet the net or individual amounts. Just like we did for P&L, you don't take to the balance sheet the net or individual amount. True, 1040 should go to the balance sheet as a liability. True, 1020 should go to the balance sheet as an asset. But we don't do that as per the requirements of the accounting standard. What you do, you get the net of the two. Whatever is the net will go to the balance sheet either as a net pension asset or net pension liability. Like now we have a 20 difference, which goes to the balance sheet as a net pension what? Liability. As a net pension liability. Our liabilities are more than the assets. It goes to the balance sheet as a net pension liability. It could go to the balance sheet as a net pension asset, whichever the case might be. Okay? Good. So I'm through with how the defined benefit plan affects the balance sheets. Also through on how it affects P&L. Somebody could ask, we have computed some figures called actuarial gains or losses. Why are we not taking them to the P&L account? When I was mentioning what goes to the P&L account, we did not say what about the actuarial gain or loss. They sound like they should go to the P&L account because they are gains and losses. But again, when it comes to this topic of accounting for retirement benefits, those gains or those losses, listen, they don't go to the profit and loss. They don't go to the profit and loss. Listen to this now. What we want to talk about now is how do we account for the actual gains or losses. Listen, the actual gains or losses should be considered as part of other comprehensive incomes, in the statement of comprehensive income. Actual gains or losses should be considered as part of other comprehensive incomes in the statement of comprehensive income. Listen, when you are doing financial reporting, you did a topic called published accounts. And in that topic of published accounts, you learned how to prepare a statement of comprehensive income. You learned that in a statement of comprehensive income, you normally start with the normal income statement. After you're through with the normal income statement, then below there, you normally show what we call other comprehensive incomes. You list them. I do hope you can remember a few examples of what you used to list as part of other comprehensive incomes. Obvious. In your normal statement of comprehensive, I'm assuming you have prepared your normal income statement, and of course, I do hope you remember when you are doing this topic of published, ulikuwa unapata something called profit after tax, then unakuja unashow other comprehensive incomes. Then you will have to list those other comprehensive incomes. Just to remind you, one of them that you used to use is something we could call gain or loss on revaluation. Gain or loss on revaluation of fixed assets. Whenever you used to revalue fixed assets, whatever the gain or loss on revaluation, you never used to take it to the P&L account. It is considered to be part of other comprehensive incomes. Listen, what I mean is this. Whenever you used to revalue land, for example, you had to debit land, assuming land had a book value of 100 million. Then you revalued it by another 20 million this year. You normally debit land by 20 million, and the double entry is that you credit revaluation. You debit land and you credit revaluation by how much? 20 million. We normally don't debit land and credit P&L account by 20. As much as it's true, 20 million is a gain, you normally don't take it to the P&L account. That's not the rule of accounting. The rule says you debit asset, credit revaluation reserve. But is that 20 a gain? Yes. So that's why we normally show them as part of other comprehensive incomes. So now we are saying, apart from that 20 here is another example now of another example of a comprehensive income. That's what we are calling actual gain stroke loss for this year. Again, listen, just like in the P&L account, just like in the balance sheet, you don't take to the comprehensive income section two amounts. One for actual gain on assets, maybe actual loss on liabilities. No. You get again the net of all of them. For example, when you look at when we were doing the computation of the assets, we saw assets had an actual gain of 30. In the same year, our fund as a liability had an actual loss of 30. Maybe we can even make it 40 now, whatever the case. Okay? So, Unakuja unasema hii ni 40 loss, 30 gain, unabaki na net ya how much? 10, maybe as a loss or it could be a gain. If it's a gain, you come and say a net actual gain of 10. If it's an actual loss, you minus 10, whichever the case, but you call it net actual loss. So that's how you treat the actual gains or losses. You show them as part of other comprehensive incomes. Good. I think I've summarized everything concerning how to account for a defined benefit plan in the income statement, in the balance sheet, and in the section we are calling other comprehensive incomes. We have also discussed how do you compute the actual gain or loss on assets and on liabilities. I started with the assets. I said, find out from the question, what is the value of the assets by the beginning? We were assuming 100 or 1 billion, whatever the question will give you. Then I've told you, look for those transactions that affect the value of the assets. We have identified 3. Whatever is the expected return on assets, any contributions received by the fund, any benefits paid. We have agreed expected return on assets will make the value of the assets to go up because it's an income. The assets are earning. Assets are in form of investments. Contributions received, we have agreed, will make the value of the assets also to go up. Benefits paid will make the value of the assets to go down. Get what ought to be the value of your assets. Compare with what the actuaries will give you as the evaluation. Difference is either an actual gain or loss on assets during that year, whichever the case might be. Repeat the same for the liabilities. Look at your fund as a liability also in that particular year. Find out what was the liability by the beginning, whatever the question will give you. Look for those transactions that affect the liabilities during the year. We have identified 3. 1 is the interest expense, service cost. Wait. Oh, I thought I had not said something. Good, I have mentioned it. And benefits paid. Good. Once you identify them, we have said interest expense, service cost will make our liabilities to employees to go up. Good. Benefits paid will make our liabilities to go down. Get what you think ought to be the liabilities, compare with what the actuaries will tell you. Good. Once you do that step 1, computing the gains or losses, the actual gains or losses, now you go to the next item. Compute the net pension expense. That's what I thought I had not said. Kumbe I've said it. Okay. Net pension expense, what goes to the P&L account as the charge for the year. We have said, look at your fund from the point of view of its liabilities. Are there transactions that took place in the current year that affects the P&L account? That those transactions affecting liabilities that go to the P&L account? Yes. We have identified how many? 2. Interest expense and the service cost. Said, interest expense should go to the P&L account as an expense. Service cost, whether current service cost or past service cost, it doesn't matter. It is a service the employees have given you. Charge the P&L account. I said you charge that. Why? Because we prepare our income statement on a basis we normally call accrual concept. You recognize costs when they are incurred, but not when money is paid. We were assuming we incurred a cost of 50 for the service, but it looks like we have only paid 30 as contribution. So it's not what we have paid for the service, it is the charge. Good. The other transaction that affects P&L account, we said, is the expected return on assets. Of course, that's an income. goes to the P&L account as an expense, as an income on the credit of the P&L account. Because you want to get the net of all of them, you minus, you net it by minusing. Then you get what we are calling net pension expense. Good. Then liability, or in the balance sheet, sorry, get the liabilities by the end of the year, the fund, compare that with the assets by the end of the year, get the net again, either as a net pension liability or as a net pension asset. Good. Then I have also summarized by saying, or we are finished by saying, how do we treat the actual gains or losses? We have said they should be considered as part of other comprehensive incomes in the statement of comprehensive incomes. Again, we have said get the net to be the net actual gain or net actual loss in a particular year. Good. I think I've summarized everything. So what we shall do next time, because we have no time, maybe for today we can stop there. Next time, I'll give the notes now. And then from there, we now do a past paper question. We shall do, or we shall give the notes now, then we do a past paper question. So maybe for now, we can stop there. We pick it up from there next time, where now we shall give the notes on what we have discussed today. Then once we write the notes, we shall now do a past paper question. So see you next time, which is on a Monday evening. Good. Good night. See you next time. Have a nice weekend. Bye for now. Bye for now. Bye for now. Okay. Good night. Good night. First, by the way, I need to also find out. I also need to find out whether the sound is loud and clear. Somebody to chat and say whether it's loud and clear. Is the sound loud and clear? If it's loud and clear, you chat and you say loud and clear. Is the sound loud and clear? If it's loud and clear, you write there loud and clear. Somebody to chat and say whether the sound is loud and clear. Good night. Thank you. What about the sound? Is it loud and clear? Is the sound loud and clear? Somebody to chat and say whether the sound is loud and clear. Yes. Thank you. Fine. Okay. Good night.